Well, let's do this. Good morning, good afternoon, everybody. Happy Friday Eve. It's the most glorious day of the week because it is webinar day. I'm going to open my chat pane here, and you should as well, because if you have questions as we go through this, like we do on all of our webinars, I always try to keep these pretty interactive. Or if you have any feedback, any suggestions, anything that the rest of the audience should know about, feel free to put them in the chat pane there. And assuming it's politically correct. Heck, even if it's not politically correct, I will probably read the statement that you put to the rest of our audience because, well, we all like to know what each other is doing in our practices. If you all can see me and hear me, please note that in the Q&A or in the chat pane. Forget the Q&A pane, but the chat, heck, use whatever one you want. The chat pane, tell me if you can see me, if you can hear me, because that tells me that, well, our audio visual is working. And of course, it also conditions you and how to ask questions as we go through this. Here, let's see. How many folks do we have on? We have on a good group. We have 87 on this one. This is another good webinar. Long-term care annuities, what I believe to be the foremost missed opportunity that's out there. In other words, you have a ton of folks doing annuity business, and a lot of annuity folks, reps, agents, don't like the conversation of underwriting and long-term care. It just sounds boring to some folks. And therefore, you may have neglected to learn about anything having to do with long-term care in the past. I'm here to tell you, though, this is a huge opportunity. The long-term care conversation, at least when it comes to long-term care annuities, is a very easy conversation to have, especially if you're already talking about what you would when it comes to annuities, as in collecting assets, $100,000 here, $200,000 there. Annuity producers are, I think, the biggest opportunity when it comes to growing this long-term care business. As we get started here, I have a few housekeeping items. Number one is, as always, I want to thank you all. We are going to again double our annuity production from last year. If you look back at the last 4 years of CG Financial Group, we've pretty much doubled every year. So, this year, if we do $150 million in annuity production, which we should, there's only 1 month left. And it's a slow month, but yeah, we'll do around 150 million in annuity production. Then that's double last year. Now, is it going to get harder to double as we go? Well, of course, as we gain that scale, it will be. But nevertheless, thank you for the business that you've sent to us. If you're not yet appointed with CG Financial Group, why not? We're probably one of the fastest growing annuities, life, and long-term care IMOs in the industry. Get appointed with us. At the end of this presentation, there's the evaluation. Please fill out the evaluation. It always no, it doesn't torque me off, but it's always disappointing when I see that we had 100 folks on the line and 8 of them filled out the evaluation. So please fill out the evaluation. Tell us how we did. Did we suck? Were we great? Were we somewhere in between? All that good stuff. And you could put commentary in there as well. Do you have any questions that maybe you didn't ask in the chat pane here during the presentation that you want me to address with you one-on-one? That's what the evaluation is for at the end. So that's housekeeping one. Housekeeping two is Dallas and Des Moines. If you're in the Dallas area, if you're in the Des Moines area, looking at lunch and learns for the month of January. So in January, I want to feel out the audience, see how many folks are tentatively interested. And I'd imagine we're going to get a lot. It's pretty much inevitable we're going to do these road shows, one in Dallas in January and one in Des Moines. So if you are in Dallas or Des Moines, feel free to send me an email saying you're interested. And it's good to get on the front end because we only have so much space. So send me an email if you're interested, whether it be Des Moines in January or Dallas in January. You have my email address. Well, in case you don't, it's cgipple@cgfinancialgroupllc.com. cgipple@cgfinancialgroupllc.com. That is my email address. If you're interested in attending a lunch and learn, just let me know and I'll make sure that you are on the invite list. Bullet point number 3 here is seminars. Our seminars continue to kill it. We're getting folks in the room for, say, $20 per per household. Social Security is the main seminar that we're doing that's getting those households in the room. And there's a lot of business being written as a result of, well, these seminars. Usually, if you apply, say, $1,000 towards a marketing budget, yes, $1,000. That's like pennies when it comes to seminar marketing. Then you're probably going to at least, based off our averages over the last 3, 4, 5 years, you're going to 12x your money. You're going to get a couple sales at least from that seminar that you conducted in which you've spent only $1,000 when it comes to the social media marketing that we do. So that's a tidbit that I always like to mention. And number 4 here is, of course, a topic of conversation today. Nationwide just launched their long-term care annuity. It was last month, so it's kind of old news now, but just know that the household name, one of the household names out there, now has this long-term care annuity as we're going to talk about. So that'll be obvious as we discuss the annuity that Nationwide has that, but just know that this is a new thing with Nationwide, that long-term care annuity. So let's jump right into it. First of all, what do y'all want to learn about today? Tell me what you want to learn about. Of course, long-term care annuities, but maybe more granular. What is it that you'd like to learn about when it comes to long-term care annuities? What do you want to get out of this webinar? And as those responses are coming in, I'm going to kind of set the stage for those that don't know a whole lot about long-term care annuities, or maybe long-term care in general. Here is generally the gist of a long-term care annuity. Just to start simple, then we're going to dive into the nitty-gritty here. It's on an annuity chassis, of course. And what does an annuity chassis do? An annuity chassis says, hey, you take your $100,000 from here of non-qualified money, right? It has to be non-qualified money. Why is that? Because the IRS won't allow us to take qualified money, put it into a long-term care annuity to where later the benefits are tax-free. And that is the case with long-term care annuities. So all of these monthly benefits, the long-term care payments and stuff that we get from the insurance carriers, the benefits are ultimately tax-free, right? So you can't do that with qualified money. So it's non-qualified money. And by the way, there are options. One America specifically, the king of the long-term care hybrid marketplace, they do have an option for qualified money. It's using their life product. But just know that generally with annuities, well, pretty much invariably with annuities, that you take $100,000, it's got to be non-qualified. Okay, so $100,000 going into, say, a long-term care annuity, this is generally how it works. Is that $100,000 is probably going to grow. Say Global Atlantic, for instance, as we're going to talk about, they have a 5.5% interest rate currently on that $100,000. And yes, there are long-term care fees within it, as we'll discuss, but that $100,000, let's say it grows by 4% per year. It's an annuity. Okay, what happens if I die? Well, what happens when you die with an annuity? The proceeds go to the beneficiary, whatever that $100,000 has grown to. Well, can I change my mind with these long-term care annuities? Yes, again, at its heart, it is an annuity. You can cash it out. Just know that there are these little things called surrender charges that are 9 or 10 years, depending on which product that we're talking about here. And a lot of times at this part in my conversation with clients, the client will say, then why would I not move my 2% certificate of deposit into this? It's going to grow better. That's why I say exactly, but I haven't gotten to the best part. And here is the best part, the very foundation of our conversation here. You know I mean business when I have my trusty little whiteboard here, right? And that is what happens from a long-term care standpoint. So we establish what happens if you want to change your mind. You have that freedom with long-term care annuities. It's an annuity. What happens if you die? Well, the balance goes to the beneficiaries because that's how annuities work, right? Well, okay, so what about the long-term care benefit? Here is what happens is that $100,000 going in, that little pie from a long-term care standpoint, it turns into a total in general, and these products vary, but in general, this is the concept. It grows into a much bigger pie. That's a freaking Costco pumpkin pie, right? For like $5.99, which are awesome. It grows into that big Costco pumpkin pie of $300,000. In general, I'm speaking here, the concept. So, okay, so you want your money back, you can cash it out like any annuity. It's probably going to grow better than where your certificate of deposit is. If you die, the balance goes to the beneficiary. So it's not a use it or lose it proposition, which has kept many of you probably from marketing traditional long-term care insurance. And oh, by the way, you've leveraged up that money that's in your CD. That's probably what you would use for your long-term care needs anyway, except you'd be spending dollar for dollar from that certificate of deposit. Why not leverage that up by 3 times in this scenario? Yeah, Charlie, I don't see why I would not do this with my $100,000 annuity here. And by the way, it's tax deferred. That growth in the annuity, it's tax deferred. If you access it ultimately for purposes of long-term care, it is tax free, of course. Now, let's see, what do we have coming back here? So we have quite a few responses here. Let's go through them. How strict are the underwriting requirements? Yes, we'll talk about that. Solution for somebody only requires 1 of 6 activities of daily living. Yeah, that's a tough one because the trigger for these long-term care annuities to get this big Costco pumpkin pie, to get the long-term care benefit, with all of these, it's you cannot do 2 of 6 activities of daily living, and that's expected to last for a 90-day period of time. Or severe cognitive impairment. Those are always the cookie cutter qualifications so that the company says, yep, we're now on the hook to pay our client what we promised our client that. Yeah, 1 of 6 ADLs, I want to think about that. I would say probably there are some good, I know that there are some good accumulation annuities that also have kind of some long-term care cherries on top, so to speak. Nothing like the leverage here, but there are some options out there. But yeah, probably won't dive into that a whole lot. Let's see, long-term care rider charges. We'll talk about the charges. Yeah, actually, Sam's pumpkin pie is better. Pumpkin pie is better at Sam. I think I'm going to go ahead and delete this person and kick him out of the. No, I'm kidding. I've never had Sam's pumpkin pie, but I know Costco's is pretty awesome here. So this right here is a good story so far, but let's get beneath the surface here. Let's say that you go on claim here. And this is where we talk about the vernacular that you need to understand that some of you, I can guarantee some of you don't understand. How many of you don't even know how to spell long-term care? How many of you are not very good with the long-term care conversation? Maybe just completely green. Tell me. Don't be shy. Tell me if you don't know much about long-term care. And whether you do know a lot or not, it's important we go over some of this vernacular here and how fast you can accelerate that $300,000. Okay, so a couple of you don't know how to spell long-term care. Yep, so that's all right. That's why we're starting here. So let's say that $300,000, which sounds like a beautiful story, right? Well, does the insurance carrier allow you to say, okay, I can't do 2 of 6 activities of daily living. Give me all of my $300,000 at once. Question for you guys and gals, is that how these products work to where then the client gets a check for $300,000? Is that how these long-term care annuities work? Or not just long-term care annuities, but long-term care life insurance hybrid products as well? Is that how they work? No, because you have, like back in your math class, you have the divisor or a denominator, right? The denominator is what you divide into it. The question now is over how many months is it that the insurance carrier allows you to accelerate, or I should say mandates that you accelerate out that benefit? If this had only a 1-month benefit period, that would be a beautiful thing, right? 1 month divided in 300,000, that means heck, you get $300,000 in that 1 month. Now your total long-term care benefit hits 0 if you cash it all out. But hey, you got that $300,000 up front. The insurance companies cannot afford to do that. So hence you have these benefit periods here. So a common structure is a 6-year or a 72-month benefit period. This is a common structure. But what did I just state there? What I just stated was the shorter the benefit period, actually the better, right? I mean, if you had just a 1 month benefit period, which doesn't exist, then that means you have a maximum monthly benefit of $300,000. So let's take the normal structure of 72 months. So 72 months, if you take $300,000 and divide 72 months into it, what does that mean? Well, simple math says 6 years, which is 72 months, that's $100,000 a year, right? What happens if you took, 70, what is that? 72 divided into 300,000. Somebody calculate that for me. 72 divided into $300,000. And we'll see it here on the ledgers in a bit. But that's what arrives at your maximum monthly benefit. Now, vernacular here. Well, Charlie, okay, so that comes out to, well, let's just calculate it. Yeah, it's 4166, 4166. So that means no more than $4,166 per month can you access that $300,000. Obviously, it doesn't take a mathematician to tell you that if you're on claim for 72 months, taking out 4166, that's going to hit zero, right? And that's a beautiful thing. You put in 100 grand, you got back $300,000, 100% tax free. So in other words, there's a moderation in how fast you can take money from that. I bring all that stuff up because in general, all else being equal, the lower the benefit period, like Equitrust, for instance, we'll get into that. Theirs is 60 months, not 72 months. So therefore, Chris, calculate this for us. All else being equal here, if we have a 60-month benefit period, then what is that maximum monthly long-term care benefit going to be for that Equitrust product? Well, because they'll allow us to accelerate that over, well, yeah, of course, 60 divided in 300, that's $5,000 a month. So they're allowing us to accelerate it a lot faster. Conversely, what if the company says, "Oh, you have a 300-month benefit period"? Well, crap, that's ridiculous. That's only $1,000 a month. I'm probably going to be on care for only, a male 36 months or 24 months, a male, a female 48 months. I'm going to die before I even tap into a good chunk of that 300,000. So just know that this is the analysis that needs to go into these products. What's the benefit period? Two very important things. What is the size of the long-term care pool? One, and number two is how big is that divisor? The smaller, the better in many cases. Now, you're going to, when you write your first long-term care annuity, which has to be with CG Financial Group, it's state law, right? That it has to be with CG Financial Group. Here is actually what you're going to see in the policy. Here's what you're going to see in the policy. That $300,000 pie, it's technically divided into two different sections. One section is 100, dang, I'm like dyslexic today. $100,000, right? That's the client's money. That's their contract value there. That's their own money. But then the other chunk of the pie is, well, the $200,000. So here's what happens a lot is agents call me up and they say, "Charlie, this is freaking ridiculous. I'm opening my client's policy and all I see here is this acceleration of benefit rider that says that I can accelerate only $100,000 of my client's money to the tune of $4,166. And that only goes, Charlie, for 24 months, I said, okay, so you're probably wondering where the other $200,000 is, right? Like, yeah, turn the page. Let's pay attention here. Turn the page, and here's what you'll see. What you'll see is hey, you have another $200,000 that once this is gone, that other $200,000, what is this rider called, folks? What is this rider called? Is it an acceleration of benefit rider? No. What's that rider called? The additional $200,000 above and beyond that client's $100,000. It's an extension of benefits rider. So that other page will say, oh, and by the way, you have an extension of benefits so that long after your money is gone, you have an additional $200,000 here. And that $200,000 can be accelerated over a 48-month period of time. Now, would I explain all this crap to the clients? No. But what I do explain is 72 months, 48 plus 24 is how fast that they can take out their $300,000. But just know when you get your first policy, that's kind of what happens with it. And what I also wanted to demonstrate there is that's the difference between accelerating your own benefit or life insurance. An AOB rider is accelerating the death benefit. But then you also have that extension of benefits rider or continuation of benefits rider. So what I just explained there was also this. Intuitively, you can arrive at the answer. If you were just listening to what I said, you can arrive at the answer to this question. Common question. Okay, Charlie, so what happens if I'm on claim and say $200,000 of that $300,000 I've used up? I'm on claim, I've used up $200,000 of my $300,000 and I pass away. What does my beneficiary get? In other words, where was my money coming from? Was it coming from my policy value? Or was it coming from just this over here? What did I just explain there? If somebody has a $300,000 long-term care benefit, but their contract value is only $100,000, but they've used up $200,000, what's the death benefit when that client passes away? It's kind of a tough one here. What's the death benefit? Yep, it's zero. So what I just explained there was a lot of stuff, vernacular, as well as how to look at the policy, as well as to answer the question, whose money is used up first? It's the client's money that's used up first. But hey, if you've used up your money and you're dipping into that, that's kind of cool. We're in the money here and you're accessing it tax-free, right? So that's a good thing. But we hope that you access all of the $300,000. So the client's money is used up first. And this is simplified because technically, if the client puts in 100 grand, that 100 grand is going to grow. And 3 times whatever that is grown to is what that, so the Costco pumpkin pie, it like gets on steroids. It gets bigger as time goes by as well. So that's simplified, but I wanted to get some of that vernacular, some of the workings out of the way. Any questions thus far before we dive into the good stuff? Does that help? Does that help with the vernacular, kind of how these things operate? Excellent. Glad to see that. All right, what's this? This is why doublers on annuities are usually no good. I'm so glad you mentioned this. Doublers on annuities. Let's do some freaking math here, folks. Okay? And this really torques me off when I see the guys on social media that, what is it, the Dunning-Kruger effect, that assume that everybody's an idiot and doesn't know what they're talking about, and that they don't know what they're talking about. And the best long-term care alternative is an income doubler. So let's do some math here. You have $100,000. Let's talk about the income doubler. $100,000. Let's say it's a 65-year-old client. What's a good payout factor for a 65-year-old client? So we're talking riders. People say that, oh, these income doublers on these riders, they're a good long-term care alternative. No, there's no leverage there, zero leverage there. So say a 7% payout factor, so you're getting $7,000 per year in income from that income rider, which is good. That's good from an income standpoint, but what about from a long-term care standpoint? The insurance company says, well, we'll double that. We'll double that for you. So for 5 years, or until your account value is gone. I won't go into that stuff. So we'll give you $14,000 per year for 5 years. 100 grand going in to get $14,000 out that's just using up their own money. And when your $100,000 is gone, it drops back down to the $7,000. Is that any type of leverage whatsoever versus something like this, 100 grand going in, we get $4,166 a month or 50 grand over a year? To me, 50 grand is a heck of a lot more than $14,000. No, income doublers on annuities, They're a nice cherry on top. They're a nice, oh, by the way, but it is not a long-term care alternative here. And here is the beauty of these annuities as I pull up my screen here. I write for several publications through the industry, and now I'm writing for Insurance Newsnet. And my first article, I think it's actually live as of this morning. If you subscribe to Insurance Newsnet, you'll see it out there. But I talk about opportunity cost. You know, everything that we do in finance has an opportunity cost. What is opportunity cost? So here's the example that I use is it's Christmas time, right? A few years ago when my teenager was a pre-teenager, dramatic, right? He says, oh, I just want cash for Christmas. I don't want any presents, like Matthew. You don't want to open any presents up at Christmas time. You just want a big pile of cash. He goes, yeah, I do. I'm like, okay. His older brother, Seth, wanted a ton of presents, ton of clothes, shoes, whatever, basketball clothes and stuff. Even though we warned Matthew, Christmas came. Seth's unwrapping all of his presents there. And what did Matthew get? He gets an envelope. Granted, we tried to wrap everything, socks, toothpaste, and all that, so Matthew could do some stuff. What did Matthew say? He said, this is the worst Christmas ever. What he just experienced, and that's what he said. He literally said it was the worst Christmas ever. Said, Matthew, we told you about this. He realized what this economic notion of opportunity cost is. When you decide to apply resources, money, your time to one particular space, you're not able to participate in another area over here, right? That's an economic term called opportunity cost. If you tell your clients that they'll be good in a 5% annuity, guaranteed, which is very good. These exist today. We have a lot of them. But yet if the stock market skyrockets, that client has just experienced an opportunity cost because they were not in the stock market. So they may view that as a cost. Dave Ramsey says, oh, pay off your 3% mortgage. I say BS. Why? Because if I can otherwise invest that, whatever, $500,000 into something that's going to get me 5%, to where I'm only paying 3% on that, that's an opportunity cost here. These long-term care annuities, my point is these long-term care annuities, whether it's losing control of your money or whatever, there are very few missed opportunities that can be had with these long-term care annuities. You're getting a higher interest rate than where your CD is, Mr. Client, Mrs. Client. If you die, it's not a use it or lose it like long-term care is. That goes to the beneficiary. Do I dare say it's almost a risk-free long-term care transaction to have with your clients, which is not the case with traditional long-term care insurance, right? If you don't use it, you lose it. That's a big lost opportunity there, right? So it's a very good long-term care strategy for the annuity agents. So here's what we're going to do. We're going to go into some illustrations here, but I threw together this spreadsheet real quick. I actually had One America on this spreadsheet, but just know that One America is not on here, not because One America is not good. Make no mistake, One America is the cream of the crop in the industry, right? It's just that One America has two products, the Annuity Care 2, that acts very much like the Global Atlantic Forecare. They also have the Indexed Annuity Care that works very much like the Equitrust Bridge product. So frankly, I thought it would be redundant if I had those two on here and if we went into One America step by step. But make no mistake, they are the best in the industry with their option because they have almost every option that's out there, right? So let's get into these options here. Let's talk about, first of all, underwriting. In general, here is how these annuities work. This is Nationwide's one-pager on their underwriting. You have height and weight. It's simplified underwriting, of course. You have height and weight, and then you get the opportunity to pre-screen your client. So for instance, whether it's Global Atlantic, whether it's Equitrust, whether it's Nationwide, these are the gist. This is Nationwide's questions, but kind of the gist of Global Atlantic and Equitrust as well. There is no coverage with Nationwide and Global Atlantic if the client answers yes to any of these questions. For instance, are you currently hospitalized? Are you currently confined? Those are pretty severe questions, right? So there are 5 knockout questions with Nationwide and Global Atlantic to where, hey, the client's not going to get coverage. Now, where Equitrust is unique is that it is a guaranteed issue product, right? Even if they answer yes to these knockout questions, or they just don't want to go through underwriting, the client has a guaranteed issue rate class, so to speak, that they will get. Obviously, it's severely watered down from this type of stuff that we're talking about here, but this is the gist of the underwriting. But then what Global Atlantic does a good job with is they will say, okay, so if you haven't checked yes to these severe questions here, then you're either going to get double your money or triple your money. And Equitrust kind of works the same way. It's not quite double, not quite triple. It can be more. But Global Atlantic does a great job of laying out. Now, this set of questions here, the second set, if you don't answer yes to any of these questions, then you will likely get triple. You'll likely get triple, what Charlie's talking about here. Equitrust, it's kind of the same thing, although they don't lay out that second set of knockout questions. It's actually an interview done over a webinar to where they have the client sit up and stand down and do a cognitive exam, stuff like that. But what Global Atlantic does, as well as kind of Equitrust, like I said, is they say, okay, if you answer no to these second set of questions, you're likely going to get the triple benefit here. If you answer yes to those questions, you're going to get the double benefit here, which means, again, $100,000 going to $200,000. With Global Atlantic, you divide that by 72, and you're going to have less of a benefit than if you otherwise got triple. So the underwriting process with all these is simplified. There are knockout questions to where you know if that the client shouldn't even apply. Or with Equitrust, they can still apply. It's just really, really watered down. And then there's a second set of questions to where that determines if they get double or triple. There are no medical reports. There are no attending physician statements that are requested with any of these products. Depending on which carrier, like Global Atlantic says, we don't even do a phone interview with the clients unless they're 70 or above. So we don't even need to do a cognitive interview unless they're 70 or above. These companies, they'll do stuff on their end to where, not attending physician statements, but medical information bureau, prescription check, motor vehicle report. But say like Global Atlantic, for instance, nationwide as well, they'll come back within a couple days and say, yeah, you're approved. Or you're approved for the double benefit, not the triple benefit. I have a client with breast cancer and chemo, and I do not see that on the knockout. So it's not on this knockout here, but with Nationwide, what I can do, Chris, is I can send you Global Atlantics that does a better job with the second set of knockout questions. So yeah, if they're not on this, then the chances are that the client, they'll get a policy. The chances are, there's never a guarantee with this crap, believe me. Never. Well, they didn't answer any of the knockout questions, underwriter, negatively. Well, yeah, but what we found, blah, blah, yeah, whatever. But more than likely, they will get the double benefit, whether it's Global Atlantic, Chris, or whether it's Nationwide, more than likely. So yeah, if they don't answer these, then it's a question of, do they get the double benefit or do they get the triple benefit? That's generally the gist of how underwriting works with these. You send them through Mutual of Omaha, traditional long-term care insurance, where they do the full boat, attending physician statements, all that stuff. Boom, declined, right, Chris? That's the difference between this stuff and the traditional long-term care. And I love traditional long-term care. It's just, they're two different things. Issue ages. So I have an 80-year-old guy who has a bunch of money. Kind of the sweet spot is those that are, I would say, 65 plus that have enough money to retire on, and maybe some lazy money sitting off to the side to where it's like, yeah, instead of long-term care, spending it from my CD dollar for dollar, let's triple that up here. So Equitrust does not adjust, or I should say Global Atlantic does not adjust their benefits based off of whether you're 80 or whether you're 55. Equitrust naturally does because they have the Like for instance, if you're 80, you might not get triple. You might get, I don't remember the chart, but you might get 250% of what you put in. So maybe 250,000 or something like that. So Equitrust has a sliding scale based off of age, what that ultimate benefit is. Global Atlantic, it is 50 to 80. You're either going to get triple or you're going to get double based off those knockout questions that we talked about. Nationwide, they have a select class for those that are 75 plus, which means you're only going to get the double benefit, but not just that, not just the double benefit, they also adjust that divisor as well. They make you spread it out over a longer period of time, as we'll talk about here. So, which one do I like best for, say, my 80-year-old dude here? Global Atlantic. I ran the numbers and I like Global Atlantic the best for him. Now, if he were to come back and say, but, and this is where we get into this bottom chunk here, this bottom line. If he were to say, well, I want a family member to take care of me. I want a family member to take care of me. I don't want a licensed care practitioner to take care of me. Can I access the policy if it's just like my son that's taking care of me? With reimbursement policies, this is a difference between reimbursement and indemnification. To skip ahead to the bottom here. The difference is reimbursement, A, only reimburses for the amount of care that he needed during that month. But also, B, it has to be a licensed care practitioner. So, in other words, let's say that his benefit is his monthly benefit is say $5,000 a month, but he only needed care to the tune of $4,000. That $4,000 is all that's going to be paid out. And it's only going to be paid out if he was taken care of by a true licensed care practitioner. So naturally, folks like all else equal, which is never equal, indemnification. They like indemnification the best because, hey, 5,000 is your benefit. The doctor signs off that you can't do 2 of 6 activities of daily living, and boom, we're going to start paying you out your 300 grand to the tune of whatever the monthly maximum is, right? $5,000 a month. You get that check. You do whatever you want with that check, pay your family, whatever. So that's a little bit on indemnification versus reimbursement there. So these 3 products, the Equitrust Bridge product is based off of an index chassis. So where I talked earlier, like Global Atlantic, it's based off of a fixed chassis, 5.5% interest rate, or 6% if the client has more than 200,000. Equitrust is based off of an index chassis, and that is currently their S&P 500 cap is 9%. So the market drops, you get a 0. The market goes up, you get whatever the market went up to 9%. But of course, with all of these, there are long-term care charges, which we'll talk about, embedded into these products. Now, what you'll see on the Global Atlantic illustration in a bit is that it is what is called a traditional fixed rate design. So what that means is it's guaranteed at 5.5% for 1 year, but then after that, it can change. My experience with Global Atlantic is they've been very good with their renewal interest rates. If it issues at 5.5%, it's probably going to be around 5.5%, to where the minimum is, we'll look at it in a bit, around 1% is the minimum rate. So that's the difference between Equitrust and Global Atlantic. And no, Chris, it's not 0.5. It is, well, I'll tell you right here, it's 1%. It's 1% with Global Atlantic. And then you have Nationwide. So Nationwide more closely resembles Global Atlantic than it does Equitrust. Why is that? Because it is on a fixed rate chassis, a guaranteed fixed rate chassis. But here's the kicker with Nationwide, is it's not 5.5%, it's 3%. But here's the benefit to Nationwide, is that it's a guaranteed 3%. So to where Global Atlantic's fixed rate can fluctuate between higher than 5.5, I guess, down to 1%. Nationwide, it's 3%, period. Is there a joint option? Yeah, there is. With Global Atlantic, there is. Global Atlantic, as well as One America, has joint options here. Um, Husband and wife. Global Atlantic will allow you to take that $300,000 long-term care pool and say, okay, can we have the husband and wife both share that long-term care pool? It doesn't take a statistician to tell you that the odds of one person of a couple using that long-term care benefit is greater than the odds of one person using that long-term care benefit, right? So this joint option, and from a pricing standpoint as well, the joint option with Global, and follow me here, this is important. The joint option with Global Atlantic not only means that it's more probable that they'll use their benefit because it's two people, but it's also a stronger monthly benefit per person than if you otherwise to split up the 100, 50,000 here, 50,000 here, and have each of them have their own policy. So again, there are economies of scale there when it comes to joint options. If you're dealing with a husband and a wife, almost all the time it's either One America or Global Atlantic. Sometimes for various reasons, you may want to do two separate policies, but that's certainly not the norm. All right, so let's talk about underwriting classes here. So, like I said, Equitrust, you have three different classes. You have their preferred class. That means all the knockout questions were answered favorably. You did good on the phone interview. And I say 3X-ish because they have a sliding scale to where, hey, if you're 79, you're going to get a little bit less leverage than maybe three times than if you're otherwise 75 or 70, right? So Equitrust kind of complicates it a little bit with a sliding scale depending on age there, but that's on every illustration that I run for you. You see what that leverage is. I want to say for my 70-year-old female, it was we'll look at the illustration, but it's like 330% is what that Costco pumpkin pie is. So not 300% like Global Atlantic, but like 330% or something like that, as we'll see. But of course, if they answer those unfavorably, or at least that second set of knockout, or the phone interview doesn't go well, then, hey, we're sorry, we can't give you 3X-ish, we'll give you 2X-ish. So that's the second layer. So again, a lot like Global Atlantic there, but where Equitrust varies from all of these carriers is that even if the client doesn't want underwriting, the client is, heck, on their deathbed, they guarantee issuing to the client. It's a guaranteed issue. Now, can I argue against the guarantee issue? Yeah. So here's an example. Your $100,000 goes into this guaranteed issue class, and maybe the leverage is 130%. 130%. I want to say that's roughly what it would be for our 70-year-old. 135%. So your 100 grand turns into $135,000. And then the company says that you have to spread that $135,000 long-term care benefit out over a 60-month period of time. Equitrust has the lowest denominator of all of these. 60 months, not 72 months, 60 months. And that's why you'll see that when we get into the nitty-gritty here, they have the highest monthly benefit because they don't mandate the client to spread it out over so long. All right, so 60 months divided into 135,000. Heck, that's just a decent annuity where the client can access what, roughly $2,500 per month. Any annuity where you put $100,000 into, I mean, heck, you can almost access that much, right? So you kind of get to where it's like, okay, but is the guaranteed issue, is that more sizzle than steak? I go back and forth on that because you could probably find a good accumulation annuity that may potentially do better than that without the long-term care fees. Now, question for you, the smart folks, which is everybody on the call, I'm sure. What might be a really good strategy when it comes to the guaranteed issue? When might that guaranteed issue long-term care policy far exceed anything that you can do in a decent growth annuity. What am I referring to here? Robert, boom. Chris, yep. A tax play, a tax play. So Equitrust as well as One America, it's almost guaranteed issue. There are severe knockout questions. If you don't answer yes to any of them, then you get their indexed annuity care. So again, this product, indexed annuity care, One America, kind of resembles Equitrust. Basically guaranteed issue. Okay, you have an annuity over here where you put 50 grand into it. So I'm not talking CDs now. The client has a current annuity where they have 100,000 bucks in there, but they only put in 50 grand. That gain would normally be taxable, right? Well, however, if you move that over into a long-term care annuity and then, yeah, access it to the tune of $2,000 a month, is any of that $2,000 taxable when used for long-term care? No, the gain that you got previously, it's never ever taxed when used for long-term care. It's never taxed. So that's largely a tax play here. So that's a little tidbit on this the guaranteed issue with Equitrust. By the way, commission wise, not that we care about commission because we're all 501c3s around here. I swear some people think I am a 501c3. We're all nonprofits around here, right? But I'll mention commission anyway. Equitrust is going to have the highest commission, then Nationwide, then Global Atlantic. Ask your agency, whatever agency you're a part of, what that commission level is. Ask me if you want offline. It depends on if you're a part of an agency, somebody else pays you commission. But I will say that these products are in line or greater than, say, a 10-year indexed annuity, commission-wise. Equitrust is by far and away above any of that stuff. Then again, Nationwide, then Global Atlantic. So they pay you quite handsomely as well to address this very important risk here. All right. Global Atlantic, like I said, knockout questions. You get either 3 times or you get 2 times. Nationwide, a similar deal. You have the 3 times, then you have the 2 times. Here is a tidbit on, oh yes. So I put a note here. Select. So that last rate class for the older folks, those above age 70, I put 72 months here. That is because what you have is you have your 100,000 goes to $200,000. And a lot of times that $200,000, it's accelerated pretty darn fast, right? So, hey, you get a smaller benefit, 200,000 instead of 300, but at least you can accelerate it at the same clip as what you otherwise could have with the $300,000 option. If you're 75 or older with Nationwide, long story short, not only do you get 2 times versus 3, but you also have to spread it out over a long period of time, 72 months. So in short, my 80-year-old, this is exactly why I would go with Global Atlantic versus Nationwide, because even if my 80-year-old got the 2 times, well, he just has the opportunity to get the 3 times is actually the big thing. So my point here is work with me when it comes to more with a rifle versus a shotgun with these companies, because each of these companies have a different niche here, so to speak. All right, so here's what I ran here. Then we'll get into the illustrations for the last 10 minutes here. So Equitrust Bridge, it has the highest year 5 benefit for our 70-year-old female with $100,000. So the long-term care benefit is $5,700 per month and a total long-term care pool of not 300 grand, right? But $342,000. So, like I said, it's around 135% or 335% as a leverage. But then Equitrust says that grows by 2% per year. So Equitrust says, hey, here's your initial long-term care benefit, and then it grows by 2% per year. Over here, what Global Atlantic does is they say, hey, here's your initial long-term care benefit, $300,000. Divided by 72 for the monthly benefit, but that's going to grow based off of however it is that your contract value grows, right? So if you're getting 5.5%, it's going to grow by that minus the long-term care. So tiny differences between Equitrust and the others, Global Atlantic. But Charlie, why is it here that the monthly benefit on Global Atlantic is less than the monthly benefit on Equitrust when Global Atlantic has larger of a total long-term care pool than what Equitrust has? It's because Equitrust says that you can accelerate your long-term care benefit over only 60 months to where Global Atlantic says you have to spread it out over a 72-month period of time. So which one is better here? That's kind of up to you. It's kind of up to your judgment here. Do you prefer the larger monthly benefit or do you prefer the smaller monthly benefit? But hey, if they're in-home care, by the way, all of these cover in-home care. That's where people want to be taken care of, not in the nursing home, but in-home care. In-home care or the nursing home, if they're in there for a long period of time, well, this one has the larger long-term care pool. Which one is better? That's not an easy answer, right? Nationwide CareMatters. Nationwide CareMatters is the least of all of these. But hey, they're indemnification, they're a household name. So again, that 3 times thing, plus it's going to grow based off of how the accumulation value grows, divided by 72 months there. Now, because Equitrust, remember what I said, their total long-term care pool only grows by 2% per year. It's not based off of the index. The client's cash value is going to grow based off the index, but that does not roll over to the actual long-term care pool. Again, a little more complicated there with Equitrust. But how does that look? Well, here you can see that Global Atlantic by year 15, which is what I'm looking at, it has far exceeded Equitrust from a total long-term care pool standpoint. Why? Because it's grown by 5.5% minus the fees. And this one's only grown by 2%. And not only that, but the monthly benefit is also catching up to Equitrust. Which one is better? Again, that's kind of up to your judgment there. So let's get into, let's see what questions we have. All right. Indemnity is much better. Reimbursement is a pain to people. However, with these companies, they reimbursement, they usually deal with the care practitioner and it's direct billing back and forth. So usually people are like, oh, you have to keep receipts and all that. No, usually not. 9 times out of 10, not. What about life insurance? It's a similar conversation to all this stuff. One America, Nationwide, Securian have death benefits that are whatever. You put in 100 grand, it's $400,000, and you can accelerate it the same way that we're taught. So it's a similar concept. It's just we're referring to the death benefits versus the cash value. Can you take a percentage of gain through free withdrawals? Yeah, most of these policies allow for, client comes up with an emergency, not long-term care, but some emergency, they need to access it. Can they do that? Yes. Just keep in mind, generally, there are proportionate reductions, right? If you take out 10% of the accumulation value, then on your tripler product, then took out 10 grand here, they're going to reflect a $30,000 withdrawal over here on the long-term care side, if that makes sense. So just be aware of that. If you do guaranteed lifetime withdrawal benefits, it's a similar concept. If you're taking out X% here, your benefit base is going to be reduced proportionately here. All right, so let's get into a few illustrations here, and I'll show you what I'm talking about here. So this is Global Atlantic's illustration. This is how I sell it. Hey, your money going in, your 100,000. It's going to get 5.5%, at least that first year. It can fluctuate thereafter, and I'll show you the guaranteed ledger here. So you have roughly $5,400 in interest credit that year. How much are the rider charges? Not much. So for a $300,000 long-term care benefit, right? If you were to run a traditional long-term care policy, is that going to cost a 70-year-old female more than $2,000 per year? Oh yeah. It's going to cost her $5,000, $6,000, $7,000 per year. Absolutely. So these rider charges are a rounding error compared to if she otherwise chose long. Now, how is the company able to do that? I get this all the time. How are companies able to have pricing so good on these long-term care annuities? Think of it as a high deductible plan, right? Because it's a client's money that's being used first. That 100 grand that's coming out, it's their money first. Then the additional 200 grand, that's when they're in the carrier's pocket. So a lot of times, like I said, the client will stop me here and say, whoa, so it's going to grow by 3.5% per year, net, net, net. In this example, because we're dealing with an older lady, a 70-year-old, so that those rider charges are a little higher. Why would I not do this, Charlie? It's tax deferred. Why would I not do this if I'm getting 2%, 2.5%, 3% in my certificate of deposit? Exactly. But we haven't even gotten to the best part. And the best part is you multiply this times 3%, you have the total long-term care benefit over here. And boom, this is the meat of why you want to do this, Mrs. Client, right here. You divide whatever this value is by 72, and that's what you get there. Look at these charges that they go up. Well, obviously because the accumulation value is going up. Global Atlantic is priced, if you know life insurance, you know this analogy. It's priced like whole life is, right? To where whatever age you are when the policy is issued, we basically charge you a flat factor for the rest of your life. How is annual renewable term priced? To where each year it goes up. Why did I just mention that? Because this is what you get with Equitrust Bridge. So we're talking the contract value here. This is important for purposes of the contract value. If the client uses the long-term care benefit eventually, the contract value, I shouldn't say it doesn't matter because it does help grow the long-term care benefit. But take, for instance, in year 20 here, the client says, hey, I'm not going to need long-term care. Or they die, they don't need long-term care. The benefit, the contract value is $195,000, double what she put in that will go to the beneficiary. What about Equitrust? Let's go to Equitrust here. So Equitrust, where's 777, page 7, boom. Actually, let's go to page 8, the non-guaranteed value. So this assumes growth in the market. Look at these charges here. So Equitrust is more like annual renewable term, right? So those charges, they go up, up. Heck, we're looking at $20,000 by, that when they're 90, the same thing. 20,000 versus what was it I just demonstrated, age 90. We're looking at $3,800 in fees, Global Atlantic, Equitrust, not 3,800, but rather, here we go. I was looking at the wrong column. Double that, right? Roughly $7,300. But you can see here there's more cash value because it's on an index chassis. And we're assuming good growth on the index chassis, because that's the way index products are always illustrated. To where if you went back to the guaranteed column here to where we assume all zeros, basically, those high rider charges here, which are now $13,000, it's a net amount at risk thing, $13,000 versus what, 3,000 Global Atlantic. Now you have a completely different scenario to where you only have $60,000. So that's my way of saying that it's very easy for your cash value to get eaten up by Equitrust in later years. So just beware of that. However, what makes Equitrust so great are these values here, because the divisor is only 60 months. They only mandate you spread it out over a 60-month period of time. Again, is 60 months, but yet 60 months, but yet a smaller total benefit better than 72 months, but a larger benefit? That's really up to you and your clients. And Equitrust may have the edge because it's indemnification. Why don't I choose inflation with these products? And then we'll end here. Then please fill out the evaluation. And Nationwide, I pretty much narrated how theirs looks on the spreadsheet, right? Nationwide is just kind of in between. Frankly, from a benefit standpoint, I don't think as sexy as Equitrust or Global Atlantic, but they're a household name. They're indemnification. They pay a pretty darn good commission to you as well. Why don't I choose the 5% inflation benefit? I got this question the other day. Charlie, in all the illustrations that you run me, is there a method to the madness and why you don't run the inflation benefit on these long-term care annuities? Yes, there's always a method to the madness. I do this every day, all day. There's always a method to the madness. The method to the madness here is, hey, By adding an inflation benefit, yeah, we'll guarantee a 5% increase in that benefit here, which by the way, it starts a lot lower, right? We'll guarantee a 5% increase in that monthly benefit and the total benefit. Well, but we were getting basically a 3.5% increase without the inflation benefit. 5.5% minus a 2% charge. We were getting 3.5%. So then the next question is okay, then what does that inflation benefit charge? That conversation that you could have with the clients where, hey, your money's growing, your money's growing, you 3.5% net interest. You don't have that with an inflation benefit because you're paying $22,000 in this case, right off the bat to pay for that future inflation benefit. So it's an immediate fee of what, like 22% of the accumulation value. So it's a completely different conversation. Getting micro with this stuff is important. So this is why you got to use an IMO that knows what he or she is doing. And there are areas to where don't even talk about annuities. Talk about life hybrid products. There's a crossover point to where as they get older, the annuity route is the better way to go than the life hybrid products. Where's that crossover point? That's a topic of conversation for another day. But folks, hey, please fill out the evaluation here. Tell us how we did, and we'll talk to you next week.